Gentlemen, how you doing tonight? I'm Daniel. Just trying to sleep. The Lord awoken me, I guess, or wouldn't let me go to sleep. Wanted me to deliver a message, very stern, strong message. Okay. What we're seeing is anarchy, obviously. All these groups are forming to try to overthrow Donald Trump. What the Lord told me was that we're going to see this dust storm that's coming from the Sahara Desert in Africa is a sign and a harbinger. This Sunday is Father's Day. It is also the 21st. Now, I'm going to tell you this right now. There is going to be a
considerations due to this. So, we're fortunate in that, American Century is set up that way so that we all can work remotely, and, the wholesalers are all remote anyway, but the office staff can pretty much accomplish everything they need to from a home setting. So that's all good.
Yeah. So we're not on yet, are we? We actually, when we left Ameriprise to go to Raymond James, that COVID market and everything really hit about 3 weeks after. And so it's been an interesting time, but on the other hand, it forced clients couldn't just talk to us on the phone and, everything's fine. They were forced into virtual meeting, unlike anything if we had stayed. And so after that, clients, it was clunky up front, but by the end of the meeting, clients really liked it and are actually requesting more of it. And so, I think long term, we were in a very unique situation, but I think it'll play to our advantage, going forward. So it's,
what?
It's been interesting.
We don't have any attendees. That's really weird.
Huh.
Have you tried logging into is there another?
No, actually everything's set up right. I've just poked up all the participants. If you click on the participants, it shows attendees 0. It's kind of strange. I sent out the links. I always worry about those links if they're linking correctly, but it shows no attendees. It should have a list there.
Yeah, I'm looking at the same thing, Francis. It's just listing us as panelists and then no attendees.
That's crazy. Let me see if I got any emails from anybody. No.
Well, I just clicked on the link that I had, so it was different than the link that you just sent me, and it said you're already in that. Okay.
Yeah, I sent you a panelist link. There's a separate link for you versus the clients.
That's what I was wondering, if we wanted somebody to log in.
I am logged in right now.
But you're using our link. I'm wondering if our link is different somehow than the people.
I think it is because it doesn't show me because I'm in it. No, I have my own computer set up as a client. And it
you are in.
Yeah, it doesn't show me as an attendee on here, so I don't know what the deal is. So
are you showing participants on that one?
No, you can't see participants on the client. Yeah.
But if it's not registering you as a participant, then something is off.
It's not it's people are on there, but it's not registering on this. That's kind of strange. But I say go ahead and do it because it's not showing me on here. See. So.
Yeah, we'll want to make it. And plus we're recording it anyways. And so we do need to talk to American Century, and we'll talk to our home office about, at the very least trying to get this posted. We'll see what their rules are on both sides.
Okay, so it's noon right now. I'm going to take broadcast off, and here we go. Come on. It's not downloading. There we go. It's connecting now. Here we go. Hello, everyone. Thanks for joining us today, taking the time out and participating with our webinar today. And I have Michael Ward with me, and he's going to be kicking us off. He's one of the Caliber Wealth partners. And anyway, he's going to give a introduction to Al. Thanks for coming.
Thanks, Francis, for getting everything set up. As she said, my name is Michael Ward, one of the partners here at Caliber Wealth Management. And what we're bringing to you today, or on the website, depending on when you're watching this, is a Social Security presentation. We did this before and just had rave reviews about the content that we're having here, but also in the way that which Al is going to present this. And so we have Al Shingren with us today from American Century, and they do such a nice job. He does such a nice job with this topic, which there is a lot of intricacies in Social Security and the strategy behind it. And so really why we partner up with Al and American Century on topics like this is what we want to do is come in and say, okay, here's the bigger picture strategy. I want you to understand it as a client. And then we come in and say, okay, how does this fit specifically to you? How do we tailor your strategy? And then of course the investments around that. And so we've partnered with American Century for years. We appreciate what they do to help us to be better advisors by supporting us in this way with presentations. Plus, we feel good about some of the things that they're doing directionally. I just got an update on some of the things that they're doing investment-wise, and just really appreciate their perspective, especially in difficult times like this. So without any further ado, I will turn that over to Al. Thank you again for being here, and appreciate your support.
All right. Well, thank you, Michael and Francis, for setting this up, and welcome all of you this afternoon to this presentation. You know, I have given this presentation for, oh, wow, going on 9 years now. And so there's been a lot of questions that have been asked. And I put the presentation together with the idea that it is essential, I think, in terms of developing a long-term financial plan to understand what all your options are in developing that retirement plan. And Social Security is really forms the basis for a lot of individuals. So today I thought we'd start out with a overview of the basics, which is kind of a historical perspective of kind of where Social Security started, and given some statistics in terms of the number of people that are utilizing Social Security today. And then I think what's more important for you to understand is kind of how it works. So how do they actually calculate your benefit for retirement? How do they actually calculate the other types of benefits that are available? And you know, when do those apply? Then of course, we'll get to the question that everybody wants to know, and that's when's the best time to start taking Social Security, and we'll talk about the pros and cons of starting early versus starting late. And then I always have a couple of slides at the end to really kind of talk about, you know, the future of Social Security, because there's a lot of concern about, you know, is it going to exist in the future? A lot of people that are you know, much younger demographic are saying that's just not going to be around when I reach retirement age. And I certainly want to allay any fears as it relates to that. Having said that, though, there probably are going to be some changes, and there have been changes here, in fact, in not too recent past, and we're going to talk about those as well. So there is a Q&A box that you can submit a question, and then Francis is going to read those at the end of the presentation, and we'll cover those the best we can. So moving forward, it started by an act of Congress in 1935. And when it started, it was just a lump sum retirement benefit. It didn't really start sending out monthly checks until around 1941. Then they added a couple of benefits over the years. Benefits to survivors was actually added in 1939, and disability benefits were added in 1956. I kind of give some numbers relative to life expectancy, because I think it's interesting to note that when Social Security was enacted in 1935, the average life expectancy for men was under age 60, for women under age 64. And I think you were not eligible to participate in the program until you reached 65. So half the population didn't live long enough to actually be eligible to participate in the program. But, and I kind of find that somewhat ironic that this government program, you know, basically by design didn't cover half the population. But that's where the numbers can tell a story, but not yet tell the full story, because those are the actual life expectancies from date of birth in 1935. But if you were 65 in 1935, your life expectancy was around 10 or 11 years. So when you think about in terms of longevity of what they were looking at in terms of a time frame to cover, it was around 10 or 11 years. Today, we're closer to 20. So twice as long, and that may be one of the reasons we have somewhat of a funding issue to deal with. The other thing I think that's important to note about Social Security is that it also includes an automatic annual cost of living adjustment called that COLA increase. So it's a cost of living adjustment. Since the year 2000, it's been just over 2% on average. And there's 3 of those years in 2009, 2010, and 2016 that it was actually 0. The increase for this year, which was included in the January Social Security payment, was 1.6% increase. And so for a lot of people, that causes confusion because sometimes they don't see that amount of an increase in their retirement benefit. Some of that's because of a related program, Medicare, where premiums are deducted from your Social Security retirement benefit. Sometimes those premiums increase and it offsets some of that. I think there are at least some leading information this year that suggests that there may not be an increase for next year. Of course, that calculation doesn't occur until September or October each year, so we'll have to wait until then to find out if, in fact, there's going to be an increase next year and what that dollar amount will be. So there's a significant number of people that are receiving Social Security benefits in one of those 3 categories. It's 64 million people today, and that's as of June of last year. 15% in the disability insurance, 73% under that retirement insurance amount, and then 12% receiving a survivor benefit. So of course, for the elderly, it's the largest source of income for that age group, and that's defined by the Social Security Administration as age 65 and older. But it also included a larger benefit for people that were in a lower income bracket. And so to give you some examples, I wanted to show what the replacement values were over a number of different income levels. And Janice here, average income is just over $51,000. Her calculated retirement benefit under Social Security is going to be $21,000, approximately $250 per year. And that's a replacement value of 41%. And so when I say replacement value, I'm just really talking about how much income you receive in retirement compared to what you were earning prior to retirement. So that's the definition of replacement value. Under the second category, Bob here, his annual income, average income was around $83,000 per year. And his calculated retirement benefit is $28,147 for a replacement value of 34. So you already see a trend here, and that continues on to Grace, who has falls into the category of the maximum steady benefit amount, which really is those individuals that income over the years have exceeded the taxable wage base, and it's averaged to about $127,000 per year. The retirement benefit, which in some sense you could say is the maximum calculated benefit, is $34,380 for a replacement value of 27%. So by design, in 1935, they created a calculation that determined a larger benefit for lower income bracket versus a larger income bracket. So if you are in a higher income bracket than the ones we just talked about, you can see that there's a maximum amount, and the maximum amount is determined by that taxable wage base. And for this year, taxable wage base is $137,700. And if you earn in excess of that dollar amount, you no longer pay Social Security tax. But it also is the maximum amount at which they calculate your retirement benefit. So there is a cap in terms of how much you're eligible to receive. It is a significant portion of income for a very large number of individuals that are age 65 or older. And for that group, that 50% of their total retirement income comes from Social Security is 50% of couples and 70% of non-married beneficiaries. And for 90% of their income coming from Social Security is 21% of couples and 45% of non-married beneficiaries. And you might notice on the screen that we have a woman depicted in the icon there. And the reason for that is that the majority of that non-married beneficiary status are women because they live longer. And so you can see that they're pretty large numbers there in terms of significant amount of their income comes from Social Security. That's why it's so important when Michael was talking earlier about this being part of your plan, that you take advantage of company retirement plans and individual investment accounts and personal savings to build out the rest of that retirement income, because this program alone was never intended to be the major source of benefit in or income in retirement. But yet a pretty substantial number of people, it is a significant part of their retirement benefit. And if we look at the averages, so this is based on numbers from the Social Security Administration towards the end of last year. And all retired workers, the average monthly benefit was just over $1,500 per month, which calculates out to $18,000 per year. For an aged widower, non-disabled, it's around $1,400 per month, which is about $17,000 per year. And for an aged couple, both receiving benefits, that number is $22,530, which calculates out to an average or an annual benefit of $30,000, approximately $400 per year. So you can look at these numbers and then think back to that previous slide where we're talking about 50%, 72% of individuals having these dollars amount make up their retirement income. Again, why it's so important to plan ahead and take advantage of all the other opportunities you have available to you to save for retirement. One of the first terms that you need to be aware of is financial or is full retirement age. And I think what's important to note here is that with a lot of the rules around Social Security, there are the basic rules and then there are the exceptions to the rules. And so if you were born between 1943 and 1954, your full retirement age is 66. Between 55 and 59, it's age 66 plus 2 months for each year. So if you're 66, if you turn 62 this year, your full retirement age is actually 66 and 8 months. If you're born in 1960 or after, your full retirement age is 67. Except if you were born on January 1st, then they look at the previous year as your birth year and look at that as your to determine your full retirement age. And in fact, if you were born on the first of any month, they look at the previous month to determine your full retirement age in that calculation. So for the basic determination, it is the birth year. But if you are born on those dates, it could be something a little bit different. So how do they actually calculate your benefit? Well, first, they look at number of credits to qualify for the retirement program, and it takes about 10 years. It's 40 credits. There are a maximum of 4 credits per year, and it's based on earnings. So for this year, it's $1,410 is 1 credit. 4 times that amount gives you the 4 credit maximum per year. And then you could earn that in 1 week or spread out throughout the year. It still will, provide that 4 credits per year. And so that's why it takes 10 years. Then they look at what your earnings were over a period of time. Here's where people get confused because it's based on a 35-year highest annual earning years. So if you didn't work the last couple of years before you actually collected Social Security, as long as you had over 35 years, that's not going to impact that calculation. If you had a break somewhere between those years and maybe you worked, there's 40 years that they're looking at, but 5 of those years you didn't work, they're still going to look at the 35 highest years. Where it does have an impact is if you have less than 35 years. And those years are going to be added in at 0, so it can have an impact to your average monthly earnings amount. They take all of those years of earnings, they apply a factor to the older years. So up until age 60, there's a calculation that they determine on each year to put it into more like today's dollars is how I would explain that. And then they divide it by the number of months to get to that average index monthly earnings amount. They applied this calculation to it, 90% of the first $960, 32% of the range between $960, $5,785, and then 15% over that $5,785. So a couple of notes here. People will ask, well, what if I continue to work? And I said, can that change my benefit? And the answer is yes. If in fact that last year of income exceeds one of the prior 35 highest years, they're going to replace that number in the calculation. And yes, you should get an increased benefit due to that calculation. I've had individuals that were age 72 that had continued to work and say their retirement benefit goes up every year because their last year of income has replaced one of the prior 35 highest years, and then they recalculate that number. Social Security Administration should automatically recalculate these numbers, but if you have a question, it's worth a phone call into them to determine whether or not they're looking at that last couple of years. On the other side, that if you have lower income years in those last couple of years, it should not impact your benefit because they're going to take the highest 35. And the other factor I think that you should look at is if you have a spouse that's eligible to receive Social Security or eligible to receive benefits on your retirement benefit, then you need to factor that in as well as a part of that combined total that you're going to receive from Social Security.
Hello? It looks like we're experiencing some technical difficulties here. Please bear with us.
Kathy worked outside of the house. Her retirement benefit's $800 a month, but she is eligible for $1,000, which is 50% of Sam's benefit. It is a combination of her retirement benefit plus an additional amount due to the spousal benefit being larger than her amount. So we look at that $1,000, and it's going to be $800 of hers and $200 of an additional benefit due to spousal benefits that are going to combine to become that $1,000 benefit. The qualifiers here are you have to have been married for 12 months, and you cannot apply for spousal benefit until your spouse has actually filed for Social Security. So that's the spousal benefit. Former spouses are also eligible for benefits. And, if they're age 62 or older, in fact, both would have to be 62 or older and eligible to receive Social Security, unmarried, and if the marriage had lasted 10 years or more, the divorced spouse, ex-spouse, and that occurred over 2 years ago, then whether or not that spouse is filed, an ex-spouse can file on their record. So different than a current spouse, because current spouse, they have to wait until their spouse is already filed, but under an ex-spouse situation, you do not have to wait until that ex-spouse is filed in order to be eligible for that. There is a provision, though, that says that if you do file for Social Security at any time, they're going to look at your benefit first, and then they're going to pay out any additional benefits that you're eligible to receive. So sometimes in an ex-spouse situation, that may be provide for some additional income, and it may not if your benefit's actually larger than that spousal benefit of that 50%. So you have to look at the numbers to determine if that's something you're eligible to receive. But I advise people to, if they are divorced and they have an opportunity to file on that ex-spouse benefit, then they should go ahead and look into what those numbers are to determine whether or not there's a benefit there. If you remarry, then you're not eligible for the ex-spouse benefit. It goes to your current spouse. If you then divorce that second spouse, then you're eligible to receive an ex-spouse benefit from both or either of the two if the length of marriage lasted 10 years or longer, or, quite likely you certainly would pick the one that had the larger benefit. In addition to ex-spouses, children are also eligible for a benefit. And so children up to age 18 or 19, if they're still in high school, are eligible for a benefit. Disabled children even older than 18 are eligible for a benefit as well. And so I go back to a story where I was talking to an individual who was 66 at that time and filing under the old rules that allowed him to file and suspend, and his spouse and 2 children were eligible to have retirement benefits, and they were using that money to save for college benefits. So his spouse was much younger, which gives me the next individual that's eligible for a benefit. If a spouse is taking care of children under the age of 16, then they're eligible to receive a benefit as well. So in that situation where he was 66, his spouse was much younger, and he had a 10-year-old and a 12-year-old, his spouse and the 2 children were eligible to receive a retirement benefit. And the way it would work, as soon as the youngest turned 16, the spouse would no longer be eligible for a benefit until she turned 62, and then she would be eligible for a benefit again. So depending on ages, they can drop off. There is also a family maximum amount allowed. The bottom line is it's somewhere between 150 to 180% of the primary earner's amount. And there's a 4-tier calculation that goes into effect to determine what that amount is. If that situation applies, then you're certainly going to want to do some additional research and find out what that family maximum number is and how that may or may not impact your total benefits.
Hey,
So,
Al,
yes.
I need to interrupt you. You cut out on slide 10.
Okay.
And I've had a question that you repeat slide 10 again. I'm so sorry. You were cutting out, and I don't think anybody, people didn't hear you on that. So if you don't mind going back to 10 and
Not a
explaining.
problem. So this is the spousal benefits. And really when we were talking about the spousal benefits, if we start with Sam's at $2,000 per month, and Kathy has her own retirement benefit of $800 a month, a spousal benefit is determined by 50% of that primary worker's benefit. So in this case, it would be $1,000. Have to be married for 12 months, and you cannot apply for a spousal benefit until the spouse has applied for the benefit. In this case, our example here, the total amount of benefit for Kathy would be $1,000, but it would be a combination of her own $800 plus an additional $200 determined by the spousal additional benefit. So it's not either or, it's a combination of the two. Does that make sense? So now we're to the surviving spouse, and this is one that's, so spousal benefits are 50% of that primary benefit. A surviving spouse benefit is equal to 100% of the benefit. So in our example here, Sam's benefit is $2,000 per month. Kathy's own retirement benefits is $1,400 a month. Sam passes away, she collects the larger of the two, which would be $2,000, assuming she's at full retirement age. And we'll talk about those adjustments here in a little bit. The qualifications are different here as well. So Kathy must be at least 60 years old or 50 if she's disabled to start to receive that benefit, which then is reduced by an early filing calculation. In addition, they have to have been married for at least 9 months or prior to the death, or sometimes there's an exception in there as well that might be as few as 3 months. I talked to an individual who was married, her spouse passed away due to an accident, and she was still eligible for that survivor benefit. The other thing I think that's unique about a survivor benefit is that you can start on the survivor benefit and switch to your own at a later date, or start with your own benefit and switch to a survivor benefit at a later date. And so that's what this page is depicting. So if their benefits were the same, there is an advantage to filing past your full retirement age, and there's an advantage of getting an earnings credit, which is a monthly calculation that occurs. So in this example, it would benefit Kathy to probably collect her own benefit, or her survivor benefit at age 60 at the reduced amount, and then wait till age 70 to collect her own benefit that was eligible to receive that earnings credit. And now that benefit would be $2,640 because of the earnings credit. She cannot get an earnings credit on the survivor benefit. So if her benefit is less than the survivor benefit, and it's never going to be larger, then the opposite might be the case, where she'd want to collect her own benefit at age 62 and then something closer to full retirement age, switch it over to a survivor benefit. You have to look at both numbers to determine when it makes sense to look at that. One of the unique factors about survivor calculations is how they actually calculate that number. So if Sam is actually receiving a retirement benefit, then that is the survivor benefit. If Sam is not yet receiving a retirement benefit, then it's what he would have been eligible to receive at that time, assuming he's age 62 or older. If in fact he's younger than age 62, then there's another calculation that goes into effect that really bases it off the full retirement age and then applies some other factors into it. It's kind of a two-tier calculation. So it's worth a phone call into the Social Security Administration to determine what that survivor benefit is, if that in fact applies to you. So things to remember about survivor benefits. There are some additional potential reductions that occur with Social Security, and two of them are government pension offset or the windfall elimination provision that applies. Government pension offset occurs when someone is covered by a civil retirement system and they do not pay into Social Security, but they're eligible to receive a spousal or survivor benefits. In that case, they will reduce that survivor spousal benefit by 2/3 of the pension amount. And so they give you an example. Teachers in the state of Missouri do not pay into Social Security Administration. So if they are married and their spouse pays into Social Security and they're eligible for a spousal benefit, then their spousal benefit will be reduced by this government pension offset. Teachers in Kansas, though, do pay into Social Security, so it does not apply to them. So there are 15 states in which the teachers do not pay into Social Security. They're eligible for their state pension program. There are some municipalities that applies to as well as some not-for-profit organizations. So the bottom line here is that if you do not pay into Social Security, but yet you're still eligible for a Social Security benefit by virtue of a spousal benefit, there'll be a potential reduction there. The windfall elimination provision is really one that applies to an individual that both pays into Social Security on one job, but yet had another job where they did not pay into Social Security and they're eligible for that pension plan. So it depends on how many years you paid into Social Security on one job. If it's less than 20 years, they reduce the first tier of the calculation from 90 down to 40%. And if it's over 30 years, this doesn't apply. So it's prorated between 20 and 30 years. If this applies to you, then it's worth taking a look at. If not, don't worry about it. It doesn't apply. If you're a teacher in Missouri, then the government pension offset definitely will. The next potential reduction applies if, in fact, you collect Social Security benefits, you are not yet full retirement age, and you earn over a certain dollar amount. And so for this year, if you earn over $18,240, for every $2 over that dollar amount, they're going to withhold $1. Again, have to be age 62 or older, but less than age 66 this year. And you have to have earnings over that dollar amount. They're going to adjust that Social Security benefit. If, in fact, you turn 66 this year, then that number goes up to $48,600. And then for every $3 over that dollar amount, $1 is withheld in Social Security retirement benefits. So the calculation is kind of interesting in how they come up with this number. They look at your projected earnings for the year, determine how much of a reduction is going to occur as a result of it, and then they either, if you are just starting, you will not receive a check until that additional amount is used up in terms of that. So let me give you an example. Let's say that you are eligible for $2,000 per month at full retirement age, or you were receiving that dollar amount, and you earn $38,240. That would put you $20,000 over the number, a reduction of $10,000. Would not receive a check for 5 months, and then you receive that check for the next 7 months. Same thing applies the next year if that happens. If you're already receiving Social Security benefits and you go back to work and you exceed those earnings numbers, they're going to actually reduce your monthly benefit as opposed to withholding the whole thing. So different calculation depending on your situation. In the year in which you turn 66, again, that number goes up. If in fact you're filing for Social Security benefits later in the year and you've already earned in excess of these dollar amounts, then that number does not apply to these totals. So if you earned $60,000 between now and October, then you file for Social Security, they're only going to look at your income after the date at which you filed. So remember, all three conditions have to apply. You have to be less than full retirement age. You have to have earned income in excess of those dollar amounts during the time at which you were receiving Social Security benefits. There is a month-to-month calculation that applies in that partial year, the first year. So you can look at that to determine whether or not you are eligible to receive a retirement benefit or to what extent. So that is the earnings test. Another story about the earnings test. It only applies up until the date that you turn full retirement age. And for this year, that's 66. Several years ago, I was talking to a couple that were age 72 and they had not yet applied for Social Security because they had earnings and determined that, or decided that they would not be eligible to receive any benefit. That is not true, and they missed out on 2 years worth of benefits that they were eligible to receive because they misunderstood this part of the rules. So the only option they had was to retroactively file back 6 months, which you can do only back to your full retirement age. So if you're beyond 6 months beyond your full retirement age, you have an option of retroactively filing. This couple could retroactively file back 6 months, but they lost out on 18 months worth of full retirement or retirement benefits. So my caution is you should never delay beyond age 70 because that's when the earnings, or that's when that earnings calculation stops. So therefore, don't delay any longer than that because you'll be losing out on benefits. A quick note on that one. Also, if you receive Social Security benefits, your potential benefits could be subject to tax. And people will say, well, I thought I wasn't subject to income tax. Well, you were not up until 1983. And then in 83, they applied this 50% of the income if you were over $25,000 as an individual filer or 32,000 as a joint filer. And then in 1990, so let me explain how this kind of works.
Hey,
It is not an earnings test. So in the earnings test, now I'm cutting out. Yes.
Yeah. Can you explain that? No, not that one. The one you were on. You just cut it out for just a little bit. So sorry about that.
No, that's all right. I have an internet connection that's kind of going in and out. So this is the determining how much of your retirement Social Security income can be subject to income tax. And they look at all taxable income. So that would be distributions out of pension plans. It could be investment income. It could be rental property income. It's non-taxable interest income plus 1/2 of your Social Security benefits are added together to become a combined income number. And if that number is in excess of 25,000 as an individual filer, or actually between 25 and 34,000, or between 32 and 44,000 as a joint filer, then 50% of that retirement Social Security income is going to be subject to income tax, whatever bracket you're in based on your tax returns. If those numbers exceed 34,000 as an individual filer and 44,000 as a joint filer, then it's 85% of the Social Security income is subject to income tax. Now, the tax is not 50% or 85%. That's just the number that gets added into your taxable income. And then whatever marginal bracket you're in at that point in time is how that tax is determined. So it is a worksheet on your 1040 form. If you have questions about that, your tax professional can kind of walk you through that. But anyone who earns in excess of these dollar amounts are going to be subject to some percentage of their Social Security retirement income subject to retirement income tax. In addition to that, states as well can tax Social Security income, and Kansas and Missouri both do, albeit I believe for Missouri it doesn't start until you have combined income over 75,000 or 70 or 85,000. For Kansas it's 75,000. So the numbers can be different depending on what state you live in. There are 13 states that actually assess taxes on Social Security. 37 states do not. So depending on where you live, you could be subject to additional state taxes. So this gets to our section where we talk about when should I file, early versus late. And it really comes down to longevity, because if we look at calculators, which we will here in a minute, the longer you live, the probability of waiting or the likelihood that waiting later works to your advantage is greater. So I look at these probabilities, and this is from the Society of Actuaries, and it's basically a couple age 65 and the likelihood that the man, woman, or either of them is going to live 10, 20, or 30 years longer. And these are the percentages that could occur. So 10 years longer, likelihood that one's going to live that long is almost 100%. 20 years longer, almost 80 or just over 80%. And 30 years longer, 36% that one of the two is going to live that long. And so men obviously have a lower probability of living those timeframes than women. So you'd have to look at those numbers as well. But that kind of provides the basis for when it makes sense to file early versus late. Financial need also adds into that calculation. Whether or not your goal is to provide a survivor benefit or maximum survivor benefit also adds into that timing of when you want to start receiving Social Security. But again, I think health plays a large part in that decision. If we look at the reductions and increases as a result of when you file, there's a calculation that occurs on a month-to-month basis that looks at the day you file for Social Security and the difference between that date and your full retirement age. And then there is a reduction to that benefit if it's earlier than full retirement age, and an increase to the benefit if it's later. If it's earlier, 0.5% for each month up to 36 months, 0.512% for each month beyond that, which in total, if your full retirement age is 66, would be a 25% reduction for age 62. If your full retirement age is 67, it's a 30% reduction. And if you turn 62 this year, it's 66 and 8 months, which is going to be approximately somewhere between a 27 to 28% reduction if you file at 62 this year. At your full retirement age, it's 100%. And then for each month you delay beyond full retirement age, it's a 2/3% increase for each month, which is 8% per year, times 4 years is 32%, times 3 years is 24%. So you have a benefit by waiting. And a lot of people will say, well, I don't know if I want to wait, or do I have to decide if it's 62 full retirement age or 70? It's any time in between those ages. So when you read articles about the tens of thousands of different calculations, they're really referring to each month you could decide to start collecting Social Security. And so over an 8-year time frame between two spouses, there's a large number of different calculations that could occur. This is an example of a Social Security calculator. The page is from the Social Security website. They have a pretty basic calculator that will tell you what the 62 full retirement age and 70 estimates are. The bottom is just a calculation that I put together to kind of show you where those break-even ages occur. And for 62 versus 66, it's around 77 or 78. For 62 versus 70, it's around 80. And for 60 or 66 versus 70, it's around 82. This is for an individual. If we're talking about a married couple, it depends on age difference between the two, when they file are going to determine those. But the ranges tend to be somewhat similar to these. And we're going to walk through a couple of examples to show what those are. So my first example is a large difference between how much they're eligible to receive in retirement. Sam's full retirement age is retirement benefit is $2,400 per month. Kathy's is $700 a month. And if we're trying to maximize our benefit from Social Security, Kathy's going to file at 62, take that 25% reduction. Her benefit's going to be $525 per month. Sam's going to wait till age 70. He's going to get that 32% increase. So his benefit now at age 70 is $3,168 per month. And then when he files, Kathy's going to be eligible for that spousal benefit. So her benefit increases by $500 at that age. And then it's dollars. Because she filed for that after her full retirement age, she receives the full $500. Had she, I'm going to fall out of. Can you hear me again, Francis?
I can hear you, but that slide 20, you kind of kicked out on that one also. Yeah.
We were pretty much done talking about just those different filing dates.
Okay.
The bottom line on that was that Kathy's spousal benefit was not $1,200 because she filed early. So there was a difference, and that's why hers was $1,025. If we look at those different filing ages and we do the break-even analysis, now I'll tell you, this is a basic analysis. It just looks at how much each of them would have been eligible to receive at 62, 66, and 70, and adds up those dollar amounts to determine that, again, 62 versus 66, the break even is 877, 62 versus 70 is now 81, and the 66 versus 70 is 85. So those are the kind of ages. If your life expectancy is beyond age 85, then you're going to receive a larger overall cumulative benefit from Social Security by waiting till age 70. If it's less than 77, then there might be a benefit to filing early. So that's one way to look at determining when you want to file for Social Security. The other thing I get asked occasionally is, I started Social Security, I wished I had not. Is there anything I can do in terms of changing that decision? And the answer is, if it's within the first 12 months, there's an option called the do-over option that allows you to pay back all of those benefits and then reset your starting date at a later date. Before December of 2010, you could have done that anytime between 62 and 70. And that would have given you the advantage of, let me back up again, restarting that number. So they changed it in December of 2010. Prior to that date, it was an 8-year interest-free loan. So a lot of times we would recommend that people do that, file at 62, invest all that money, pay it all back at age 70, and keep the earnings on it. They changed the rule so you can only do it in the first 12 months. And you might ask why someone would do that. Well, let's say that they lost their job at 62, and then they found a job within the first 12 months. And so therefore, they don't need that Social Security benefit anymore. They can pay it all back and then reset at a later date. Your other option, which you have, is to suspend your benefit at age 66, your full retirement age rather. And you could then delay beyond that, and you get some earnings credit after that date until you start again. So planning for Social Security, again, it's what are your current ages? Are you going to continue to work after you start receiving retirement benefit from Social Security, because the earnings test will apply? Are you going to delay beyond your full retirement age, because then the earnings calculation, that increased amount will apply? Are you looking at survivor benefits as your primary goal? Then you probably are going to want to delay that filing date. And if you have health concerns that might have a shorter life expectancy, it might be something you want to look at starting maybe a little bit earlier. In order to be able to file later, though, you have to have income from other sources, distributions out of a 401k plan or IRA assets or annuities or investment accounts. And that's part of how you put the retirement picture together, and why it's so important to work with a financial advisor is to help you look at all of those pieces, determine what's the best end result for your situation. So everybody's is a little bit different, but you have to look at all these pieces of information in order to determine whether it makes sense to file early versus late. So how do you file? Kind of challenging in today's environment, because as far as I know, the Social Security offices are still closed, but you can file online for most things. And you can go to socialsecurity.gov or ssa.gov, and you can file for initial benefits that way. You can call the office, you can still, and they will call you, they'll set up an appointment and they'll call you back. And then hopefully within the next several months or so, those Social Security offices will be back open and you'll be able to go back into the office. You can file up to 3 months prior to reaching age 62, so you can file in advance. If you're over age 62, just whenever you want to start filing for benefits, just provide some lead time, build some lead time into that decision, because it could take several months in order to get the paperwork through, to get it set up. And of course, that first check is a delay. So if you're wanting to start in August, the August check doesn't arrive until September. So just keep that in mind when you're filing. Up to 3 months, technically up to 4 months, but I show that as some lead time just to let you know that it takes a while to file for benefits and you want to provide that or allow for that lead time. So we get to the question of what's going to happen with Social Security. And I think this chart does a pretty good job of kind of depicting what is going to happen potentially. And the darker line is the cost of Social Security benefits. Those 64 million people that are receiving Social Security benefits today are reflected by that darker line. The lighter line that's flatter and labeled as non-interest income as tax receipts. So prior to 2010, collected more in tax receipts than they actually paid out. Those dollars went into the Social Security Trust Fund, of which they then bought government bonds. And then after 2010, the interest from the bonds made up the difference of what they needed to pay out versus what they collected in taxes. That worked all the way up until the end of last year. So now we've exceeded the interest amount. They're going to have to start cashing in those bonds in the trust account, and the projections currently state, and the new projection as of a month ago still holds that 2035 is the date at which they're going to run out of the trust fund assets. That doesn't mean the benefits go to zero. It means that they're only going to have sufficient tax dollars to cover what was 80% last year's report is now 79%. So it's a little bit less. And if they do nothing between now and then, everybody's benefits across the board are going to drop by that 21% difference based on today's estimates. I don't believe that's going to happen because I'm pretty sure that if it does, that we as voters will vote them all out of office. And so I think they're going to come up with some solutions. They're actually looking at some today. And it really comes down to, how do we fill the gap? How do we avoid that 20 to 21% reduction in 2035, knowing that we need to make some changes? And so there's two ways they can do it. They can increase taxes. And basically they can look at taxing all wages rather than the taxable wage base cap that they have today. Or they could look at increasing payroll tax by 2.78% on the old report and about 3.2% on the newest report that just came out a month ago. If they did that immediately, it fills the gap. We move on down the road. Everybody has their 100% of their calculated benefits available to them to receive. On the other side, they could reduce benefits and they could raise that full retirement age up to age 70 in stages. They could also change how they calculate the cost of living adjustment, and the change CPI just basically reduces the potential increase from year to year. They could, of course, look at an immediate reduction of 17% today or 19% under the newest report. I'm pretty sure, I'd almost guarantee that will not happen given the ramifications in an election year. That's not going to happen. And the fourth thing on there, that list, is the reduced benefits for those above a lifetime wages above a certain national average, which is a means test that basically says that if you have in excess of a certain dollar amount in retirement, they're going to look at reducing your Social Security benefit. These things have been on the table since 2010. I think what's interesting is that they've actually looked at increasing payroll tax back in 2010. The recommendation was to increase it by 0.1% for 20 years in a row, which would have been a total of 2% over a 20-year time frame. Because they haven't done that, the now projection is to increase it by 3.2% immediately. So that's the problem we're running into. The longer they delay, the bigger the change needs to occur to fix the problem. There is a pending piece of legislation today called the Social Security Act of 2100, which does apply that 1/10, actually 1.2% increase per year for 24 years, or 1%, I'm sorry, 1/10 of 1% for 24 years, which then increases it a total of, the amount they need to fill the gap. It also increases some of the benefits. So if you're interested, you can look up information on that. The likelihood of that passing is pretty slim in an election year. I probably won't even get out of committee, but I'd mention it just to say that if you're interested, you can look it up, or you can call your legislators and ask questions about it, or tell them that you support making those changes. That's something that you certainly can do. So those are the potential changes that could occur. So we talked about the basics. We talked about how the different calculations are made, what benefits you're eligible to receive. We talked about the difference between starting early versus starting late. And that really is based on your own individual situation and how the numbers work out. So people will call me and say, should I start now or should I wait? And you really have to look at what are the numbers today versus what are the numbers going to look at a later date and make that determination. And with that, I'm going to leave you with another piece of advice that I pulled from a book that was written by Lawrence Kotlikoff called Get What's Yours. A little bit easier to do prior to our pandemic, but it was to go to 5 different Social Security offices and take the best offer. Now, the bottom line of that is sometimes you get differing opinions. And so it's worth knowing what your options are so that if they don't sound correct, ask for a supervisor, ask for a second opinion, because sometimes they give the wrong information. So with that, I'll turn it back to you, Francis. Are there questions that I have that we want to answer?
Yeah, we have one question. It says, what would a scenario look like if Sam was eligible for Social Security and the spouse was exactly 3 years younger, but didn't have 40 credits to qualify for Social Security? Any recommendations on what age would Sam take Social Security?
So she's not going to be eligible to get her own retirement benefit, but she is eligible for a spousal benefit. So she's going to be eligible for that 50% of what he's eligible to receive, but he has to file for Social Security in order to get that. She also then, I think, in consideration should be a survivor benefit, because a survivor benefit is going to be 100% of his benefit. She's not going to have a benefit outside of that because she didn't have enough credits to be eligible for her own benefit. So you'd have to look at, if I start at, if she's 3 years younger, you could look at, full retirement age in order to avoid some reduction on your own benefit. And then, she would have a reduced benefit by virtue of filing early. If she filed at that time, she probably wouldn't want to, if he waited till age 69, or, that might be, she was at full retirement age at that point in time, or depending what her full retirement age, he could start, filing for Social Security benefits at that point in time, and then she would not have a reduction on the spousal benefits. So looking at the numbers for each of those timeframes, so it depends what his full retirement age is and what her full retirement age will be, and then kind of determining what that 3-year gap would do if one waited until a later date to file.
All right. Well, I want to say thank you to everyone for joining us today. And if you have any other questions, you may email me with those questions and I will make sure that we get those answered. And I want to say thank you to Al for explaining all this important information to us. And anyway, just have a good day, everyone. Bye.
All right, thank you.
All right.